In 2010, a company called Quidsi was winning. They had cracked one of the hardest puzzles in e-commerce: how to sell diapers online at a price that actually made sense. Their site, diapers.com, had grown to over $300 million in annual sales. Mothers trusted it. Families depended on it. Investors loved it. The founders, Mark Lore and Vinit Bharara, had built something real, something that worked. And then Amazon noticed them. Within weeks, Amazon slashed diaper prices by 30%. Then 40%. At one point, Amazon was selling diapers at a loss, burning through an estimated $100 million, just to strangle Quidsi's growth. Mark Lore called it what it was. He said Amazon wasn't competing with them. Amazon was hunting them. And here's the thing that nobody talks about. This wasn't a one-time move. This wasn't a coincidence. This was a system, a deliberate, engineered, ruthlessly optimized machine, built not just to win markets, but to eliminate anyone who tried to compete. Borders, Circuit City, Toys R Us, Buy.com, Fab.com, Jet.com, company after company, sector after sector. The list of casualties is longer than most people realize, and behind every single one of those failures, if you look closely enough, you'll find the same fingerprints. This is the war nobody talks about, and you're about to understand exactly how it was won, the long game. How Bezos rewired the rules of business. Jeff Bezos gave a lot of interviews in the early days. He smiled a lot. He laughed that famous honking laugh. He seemed harmless. But in those interviews, if you listened carefully, he was telling you exactly what he planned to do. In 1997, Amazon went public, and Bezos sent shareholders a letter, now considered one of the most important documents in business history. In it, he wrote one line that should have terrified every retailer in America. We will make bold investment decisions where we see a sufficient probability of gaining market leadership advantages, even if it means sustaining losses for multiple years. He wasn't saying we'll try to be profitable eventually. He was saying we will deliberately lose money to win markets. That letter wasn't a warning to investors. It was a declaration of war on every business that Amazon might someday enter. But here's what most people miss. Bezos could only do this because Wall Street believed in him. Analysts looked at Amazon, losing hundreds of millions of dollars, and said, "This is fine. Actually, this is genius." And because Amazon's stock stayed high, Bezos could keep raising capital, which meant he could keep spending, which meant he could keep lowering prices, which meant any competitor trying to match him was in a race against a player with infinite chips at the table. That was phase one. Build a financial engine that can absorb losses forever. Phase two was darker. The Predator Protocol, Amazon's repeatable playbook for crushing rivals. Amazon didn't stumble into these competitive wars. They had a system, a repeatable playbook used with remarkable consistency on company after company. Step 1, identify a market where someone else is winning. Step 2, enter the market below cost, not competitive pricing. Below cost. Step 3, mirror the competitor's best features. Fast. Step 4, make them an offer. The one that never gets talked about. After the pressure campaign, Amazon often shows up with an acquisition offer that's a rescue, not a reward. Sell to us now, at a discount to what you were worth 6 months ago. Or we keep going, and in another year, you might not have anything left to sell. That's what happened to Diapers.com. After 18 months of Amazon's price war, Quidsi's investors were exhausted. In November 2010, Amazon acquired Quidsi for $545 million. It sounds like a win. But 2 years earlier, Walmart had offered $600 million, and Quidsi turned it down. By the time Amazon was done with them, that number had shrunk. And then, once Amazon completed the acquisition, they raised diaper prices back to normal. The price war was over. The competitor was gone. Mission accomplished. The book massacre, where it all began. The first industry Amazon destroyed wasn't diapers, it was books. In 1994, the American book retail market was dominated by Barnes & Noble and Borders. Borders had over 1,200 locations. Together, they controlled the literary lives of millions of Americans. Borders made a decision in 2001 that became a case study in every business school in the world. They outsourced their entire online retail operation to Amazon. They paid their own executioner to sharpen the blade. By 2011, Borders was bankrupt. 40,000 employees lost their jobs. 674 stores shuttered. And Amazon had learned something crucial: patience. The willingness to lose money for years while your competitor panics matters most of all. The Marketplace Trap: How Amazon Turned Competitors into Unpaid Spies. When you sell a product on Amazon's marketplace, you're not just using their platform, you're feeding their intelligence operation. Every product that sells well generates data: sales velocity, customer reviews, return rates, price sensitivity. Amazon sees all of it. And when a third-party product starts performing exceptionally well, Amazon quietly greenlights its own version, an Amazon Basics product. Same specs, lower price, boosted in search results. Your own sales data, which you generated, used against you. A 2020 Wall Street Journal investigation found specific cases where Amazon employees accessed data from individual third-party sellers to develop competing products. In 2021, the European Commission formally charged Amazon with anti-competitive behavior over exactly this practice. It's a trap that's too expensive not to walk into. That's not a bug in the system. That's the system. The AWS weapon. How Amazon funds its entire war machine. Amazon's retail business barely makes money, and yet, Amazon is one of the most profitable companies on the planet. Where does the money come from? Amazon Web Services. AWS. In 2023, AWS generated roughly $91 billion in revenue and accounted for the vast majority of Amazon's total operating income. Amazon can afford to lose money on retail because AWS is printing it. Every time Amazon runs an 18-month price war against a startup, AWS is quietly subsidizing that campaign. Amazon doesn't compete in retail. Amazon uses retail as a weapon, funded by a separate business that most consumers don't even know they're paying for. The irony: AWS doesn't just power Amazon, it powers Netflix, Airbnb, Pinterest. Even some of Amazon's direct competitors depend on Amazon's cloud to survive. That's not a coincidence, that's leverage. The toy store execution. A perfect case study in Amazon's corporate warfare. In 2000, Toys R Us struck a deal with Amazon, agreeing to be the exclusive toy seller on the platform. It seemed like a partnership. It was a setup. Amazon continued allowing other toy sellers onto the platform, in apparent violation of the exclusivity deal. Toys R Us sued Amazon in 2004 and eventually won. But the years tied to Amazon's platform cost them the time needed to build their own digital presence. They filed for bankruptcy in 2017. 33,000 jobs gone, 900 stores closed. A company that survived the mall era, the Walmart era, and the big box retail era couldn't survive Amazon. Not because they weren't good enough, because they trusted the wrong partner at the wrong moment. The grocery war. When Amazon came for the last safe harbor. For years, groceries were considered the one market Amazon couldn't crack. Then came Whole Foods. In 2017, Amazon acquired Whole Foods for $13.7 billion. The real value wasn't the brand, it was the locations. Whole Foods stores sit in dense, affluent urban areas, exactly where Amazon Prime customers live. Overnight, Amazon inherited 460 physical locations to use as fulfillment centers and delivery hubs. The moment the acquisition closed, Amazon dropped Whole Foods prices. The message to competitors was unmistakable: we're here now. Traditional grocery chains like Kroger and Albertsons spent years investing billions just to reach the starting line Amazon had crossed in a single afternoon. The one Amazon never fully beat. For all the competitors Amazon has crushed, there's one they couldn't buy, couldn't outlast, and couldn't replicate: Walmart. Walmart has something Amazon has never had: physical presence at scale. 4,600 stores in the United States alone. A supply chain refined over 60 years, a customer base spanning every demographic, every income bracket, every geography. When Amazon built logistics infrastructure, Walmart already owned it. When Amazon started offering same-day delivery, Walmart already had stores within 10 miles of 90% of the American population. The competitor Amazon fears most isn't a Silicon Valley startup. It's a 60-year-old retailer from Arkansas that refuses to blink. The bigger picture. What this all means: Amazon's story isn't just a business story. It's a story about what happens when one company is allowed to operate at a loss indefinitely. The companies Amazon destroyed weren't failures. Many were profitable, innovative, genuinely good at what they did. They failed because they ran out of runway, competing against a company that had effectively unlimited runway. Is Amazon a company that competes in markets? Or is Amazon a market that occasionally competes against companies? At the scale Amazon operates today, that distinction matters. Because if you're a third-party seller on their platform, a company hosting on their cloud, or a retailer trying to hold market share against their private label, you're not Amazon's customer. If this story resonated, if it changed even slightly how you think about the businesses you interact with every day, share it with someone who needs to hear it. The most important stories are often the ones hiding in plain sight. So subscribe for more videos